All right, everyone, let's do a quick sound check. Let me know if you can hear me. Alan, Bob, Bruce, Carla, Corey, Dean, Jeff, Rick, Pell, 2, 3, and 4. Let me know if you guys can hear me, and hopefully everyone is doing well. All right, excellent, everybody. So before I begin, we're going to look at actually doing something with the market as we get into the end of the year. Usually, towards the end of the year, there's a rally, a very big rally. These are just some trades I took today. I'm going to take these off. I'll show you some Atlas line and trade scalper. I'll show you guys a few things. But really, what I want to do today, this afternoon, is go over how we can approach the end of the year, which is more likely than not going to be a bullish year. Now, there's a lot of videos that I have. You can learn about the ABC method in its entirety. You can learn how I trade the news. You can learn about the ATR, which I have down here. There's so many educational free trading videos that I put out that I hope that you guys take advantage and that you email me if you have any questions. I'm happy to answer as I can any questions that come my way. And you can go to YouTube and take a look and all that good stuff. So to begin, let me first remove here everything off my chart, and let's just take a look at price action as I like to trade it and as I like to show it. And let me just take care of removing all these orders so we don't get confused over everything. All right. Now there is a storm coming through here in my area in Florida, so if the internet goes out, please just hang on. So when you look at price action, obviously we look at the candles, we look at the wicks, we look at lows, we look at highs. But when you put it all together and you try to interpret what you're seeing, why you're doing what you're doing, a lot of traders don't really understand how to put it all together. So here's where I come in. I want to actually teach you how to interpret these candles, these wicks, these bodies, primarily what to do and when and why. So for me, Eastern Standard Time at 9:30, the market opens. So here is when the market opens for me. Now for you, if you're in a different time zone, it's different. So for everybody, it's a little bit different. And as I go forward in time, I'd like to understand what the market open brings. So a lot of traders think that as soon as the market opens, there's a great opportunity. And I agree, there is a lot of opportunity. But right as the market opened, there's a characteristic that happens with volatility that it becomes a battle. And so this battle between the buyers and the sellers occur right as that bell ring, even though between the Globex and the what's called the pit session, even though there's no real pit session any longer, everything is electronic, the market is very slow leading up to the open, and then it just takes off. Now, if you have a very small stop, a very tight 1 point, a couple of ticks, especially for the scalpers out there, I want to say to you, be very careful when the market opens, because it's very common, not just the London Life Exchange Open, but also the US Open especially, that the battle between the buyers and the sellers, the market could go up and the market could go down very strong right at the open. So for all you scalpers out there that are trying to understand price action, remember, even during the Trade Scalper training, I also recommend not trading within the first 5 to 10 minutes as soon as the bell rings or the market opens, because you could have these big swings. So the first thing is to understand the moment the market opens, you have to be careful with tight stops. Now, the market goes down and keeps on going, and then it gets kind of flat like this and chops around. So after the market opens, you want to take a trade. You want to look for a buying or selling opportunity. Typically, right as the market opens, there is a push that pushes the market higher or pushes the market lower as the beginning of the day goes underway. It's not this push that I'm referring to right as the market opens. It's as soon as the market opens, there's usually a power that takes over, either a buying or selling. Now in this case, you can see the market swung straight down. Now if you had a moving average on your chart, if you had any type of indicator right at this point, you can see that it's indicating no holds bar, go short. And so if you went short here, hoping that the market's going to continue, you're out of luck because it just started chopping around. So here is a suggestion for everyone who's jumping in after the moving averages, after the MACDs, after the bands and the Keltners and all that stuff. Typically, after the market makes a very strong move either up or down, it's not to say it won't continue, but after it makes such a big push, it needs to breathe. Markets breathe just like we breathe, and it usually stops, reverses, retraces, and maybe channels or range bound. And instead of thinking that this equals a trend and a move or a continuation, think of it as a setup, not a trigger. Think of it as a setup to maybe go short into the future, but not at this low, not at this wicks low, not even if it breaks it. Prices love to test and trade where they've previously been. I'm showing you this and I'm teaching you this because I'm going to get back into how we're going to trade into the end of the day. Hey Brian, good to see you. Is that Vlad? Vlad out in Hawaii? Let me know if that's you, Vlad, out there. Hey Brian, good to see you, man. Hopefully everything is well. So when I look at taking a trade, it's not so much going into the unknown. It's really going into an area where the market has already been. And for me, I'd rather take a trade leading me into an area where the market's been, testing lows, testing highs, most recent, not lows or highs from 2 years ago, but testing where the market's just been. In my opinion, that's really the better opportunity. So if you take a look at this trend down, and you may think, hey, why not go short because my crossovers and all those indicators are indicating now's the time, you're late. The party already started. The party started as it began. Now this is 3 o'clock in the morning and the party's over, and you have to wait until the market pulls back or retraces to test that. Now, there's a million ways that you can go about doing that. You can take a look at the market coming back and then retracing back down. This is all today, by the way. But I want to show you something that I think will help you when you try to understand how price action plays a huge role in the interpretation. Now, we can look at these candles and we can probably assume that it's healthy, the market's healthy, or it's normal, but without really gauging the candles themselves and scaling them, high to low, high to low, I like to add, as you probably already know, the ATR. Setting of 4 is my recommendation, which indicates the current conditions, which then leads me to believe, is the market slow, normal, fast? What can I take out of it? So before I put on the ATR, we just looked and saw some candles. This could be 3 points in range. This could be 1 point in range. I have no idea what this is unless I really put a scale to it and measure it. But the ATR can do that for me. It can tell me right away that the market's working at about 1.5 points, even being more conservative, 1.25 points. That's really the way to go. And if I was going to take a trade short right here, I know that this is my opportunity, 1.5 points, 1.25 points, but not taking a trade at these lowest lows or going into really the unknown. Let's take a trade that's 1.5 points of profit, because that is what the market can do, but leading me down for that 1.5 points instead of going 1.5 points into the future where it may or may not happen. Take it 1.5 points down. So what that really means in the bigger picture is whatever pullback that you're referring to, whatever pullback that you're trying to understand, it has to be more than this. It has to be 2 points, maybe 1.75 points, maybe even 1.5 points. But it has to be from this level. It has to move up a certain distance so you can then go short, taking it down for this. So there should be, in my opinion, no real designation of whether or not the market can make the move. It can make the move. You just have to time it right. You have to be in the right price leading you in the right direction. So now the market comes up a little bit, and let's see what it did. It actually went from here to here, 2.25 points. That is more than enough room, more than enough, I would say, distance to test these lows, which is only 5, 6 ticks. So you're looking at an opportunity to test the lows that are 2.75, which is about 11, 12 ticks, leading you down to the lows, double bottoms, double tops, things like that, and all you want is 6 ticks. So don't cut it so close. Take a trade as the market is testing areas where it's just been. The retracement has to be at minimum this. More even would be better. Okay? Anybody have any questions on that? Alan, Dean, Jeff, Carla? Just kind of giving you a perspective on the opportunities do exist. Not every trade is going to be a winning trade. So, this idea of becoming an instant millionaire overnight, it doesn't happen. Okay, so anybody who says that to you when it comes to trading is not honest. You're going to have losing trades, you're going to have winning trades. I think the key here is to first understand what are the conditions. Can I make a point, 2 points, 3 points? What's my stop? And not only that, the relevance of the trade. Am I taking a trade just because it looks good or because the indicator told me, or is there a real reason here beyond the indicators, beyond what the guy on TV is saying to go long or to go short? And for me, I love to see markets, especially as the day begins, you have the highest volatility, highest liquidity, make some type of a move, in this case short, and then go short, leading you to where it has already traded. The retracement has to be minimum of that. So one of the methods that I teach, the at the open, which has been around for a number of years, I don't offer it separately any longer. I offer it with the mentorship, and I'm going to show you what the at the open software, which is included with mentorship, is indicating. It's indicating to go short at a point where the market first, right here, has made a move in a direction. So the idea here is to go short, leading you down to where it's already been. And the same thing with this long, going long if the market is breaking out higher into an area where it's already been. So I'm always looking for a better price and a better opportunity. The same thing if I look at the open software and method. Yesterday, same thing. I want to go long after I realize that the market has already made a move. Now I want a better price to test these highs, to test where it's already been. To me, that's a much better opportunity, especially when the market opens. Bruce, so is there any entry on this? The entry has to be, Bruce, when it comes to this here, the entry has to be at minimum when the market retraces back more than the current conditions, and then beginning to turn around and go back down. So for me, wait until it makes a new move, a new low, wait until it retraces a minimum of this value, whatever the value happens to be. It's all relative. 2 points when the market's 2 points, 3 points when the market's 3 points. I think retracing more than this value is always better. Then you can go short. Then you can plan your attack and say, this is the low, the market retraced more than this value. Now I can go short to test these lows as it comes down. Make sure that this distance is available to you instead of going into the unknown. Okay? So it has to go at least, let's say, 2 points, 0.75, 2.5 before you decide to take it back down. Now, the only reason why I'm showing you this at this point is to now focus on how the year will turn into opportunities as we head into 2017. The January effect is something that I put out there in a webinar last week. I think it was last week or 2 weeks ago. We did a webinar and videos on the January effect. You can definitely look at them on YouTube or on the blog to learn a little bit of how you can focus on January. And I'll do more of that as we get further along into January, kind of keeping up with it. But as we get into the end of the year for the last number of years has been just rallies. And the market's rallying and rallying and rallying. You're probably hearing it on a TV, rallying. But we don't want to be the last guy or gal, long at the top. We want to make sure that every new high is an opportunity to go long, just like in this case it's go short, but every new opportunity where the market makes new highs. So for example, the market is in December, and let's say this is January here, and it makes a new high. Instead of buying this new high into the unknown, let the market go back, whether it's a daily chart or a hourly chart if you're a swing trader, position trader, let the market go down the exact same distance that it's currently doing or more, and then you have an opportunity to go long as it tests those highs. I like to use the 50%, where is it here? The 50% marker to allow the market to go down a certain distance. So the exact entry, Bruce, that I'm looking at when I see these end of year moves is a clear definition of a retracement for 5 days, 4 or 5 hours from the high, and then immediately place this tool. It's not a Fibonacci value, it's just 0, the 100, and the 50. And I actually update these settings because I don't use Fibonacci's when I trade. I only use the 50, the 100, and the 0 to help me with this. And so when I look at going long, testing the highs, similarly, let it go beyond the 50% mark. Let it stop. Let it start to come back up. And when it breaks, it's going to test the highs. Not that you have to get out right at the tip. Look at the ATR. If the ATR is 3 points, 5 points, 10 points, whatever the case may be, I'm going to show you an example on a daily chart. You can have that opportunity. So don't think of taking a trade and holding on to it, although you can trail a stop, but 1 times the ATR, in my opinion, is more than enough. It's what the market is telling you that it could do. So for a daily chart, if I put on a daily chart here, and I remove all this here from the... Do you see how the market made a high here? And it started to retrace back, and it started to climb back up. All right, so where does that leave us? Well, at this point, because you're not really, we're not really doing this after the fact, that's already happened. This same example that I'm demonstrating to you right here, nothing more, nothing less, just this here, will happen multiple times, whether it be a hourly, daily. It'll happen even as we get into January. It'll happen multiple times. So I want you to recognize first this pattern of making a new high with price action, retracing more than this value. I think 3, 4 candles, well, I would say 4 or 5, better than 3. 4 or 5. I want to see a clear retracement. This isn't a retracement, this candle here. This is definitely a retracement. So it has to be something significant. And then if this happens to be 12 points, from here to here, market went 19. So I know that it went more than this value. Well, let's say 15, 16. It's still more than the current conditions. And to go long, let me just expand this nice and big. To go long, think about this idea of testing these highs right here. So you put this on your chart, you go long, you only take 1 times the ATR to test those highs. Nothing more, nothing less. You don't really know at this point if it's going to break through it or go higher. That's all you want. I would say if you're looking at a specific entry, going in right in the midpoint, right here in the center, is not a good idea. Let it break it. Let the momentum be on your side. 2204.50, 2205. That way, as it heads back up, you're going with the momentum back up. Okay, so here we are now. And the market retraced again. Now, this is not 3 or 4 days. It's just 3. It's not really enough for me to say it's significant. But similarly, if there was a couple more days here to the downside, same thing. You do this. As it breaks a few ticks, maybe a point, the midpoint, you're going long. In this example, it would be 13 points, right? Average down, be a little bit more conservative, 13 points. Like that. Now, the trade could fail. And if it fails, you have to be very careful. I don't want to see, here are signs of failure. I don't want to see this flip-flop. I want to see a direct push as if the market just explodes straight up. So be careful with the market chopping around. It's not the idea. The idea is as soon as it breaks to 50%, it makes a very strong run right to test those highs, not chopping around. That's the first thing you want to look for. It's a sign that it's not working. The second thing is that if the market comes down, you don't necessarily, unless you need to get out, but you don't necessarily have to exit the trade. I think that if the ATR here is indicating a value, this is why the market breathes. It doesn't just go straight up or straight down. It actually moves and breathes and goes up and down. It's expected that it moves 13 points, 14 points, 13 and a half, an expansion, which means if your stop is 1 point, you're going to get stopped out instantly. If your stop is 5 points, you have a better chance of staying in the trade. But ideally, your stop has to be, this is being a daily chart, these numbers are larger, but your stop has to be more than this value for you to stay in the trade. If your stops are too tight or too small behind it, it'll knock you out just unnecessarily. So if the stop is too large, go to a smaller time frame. So if I went to a 60-minute time frame here, you see how it's a little bit different. We're looking at the conditions being now, instead of 12 or 13 points, it's 3 points. Now we look for the same example. We look for 3, 4, well, I'm sorry, 4, 5, not 3, 4, 5 days, and then it comes back to test those highs. The idea and the principle is the same. It's just price action based on either a daily chart, an hourly chart, a 5-minute chart, a 10-minute chart. Nothing really should change. It's just how you understand the market is in a more volatile action. I have to do this instead, or the market is slower. I have to do this instead. Questions, Jerry? No, break, Jerry. So not just the closing. I don't want to see a closing price because the closing price could actually be over, right, when you wait for the candle to close. But I would recommend having a stop or stop with limit because it'll instantly fill you when it touches that price. So yeah, I would definitely recommend just a touch to get you in, not a specific closing price. So a 60-minute chart, you can see it a little bit better because there's more candles. A new high right here. Market retraces at least 4 days, 5 days, and you see this one pump straight up. Ideally, you want to see that. You don't want to see it, I would say, confused on what it wants to do. It should immediately test those highs, like a double top. Now, at this point, I don't really know, and this is for the day, by the way. As we get into the end of the year, I'm not referring to all-time highs. I'm referring to highs for the day. So let me just be clear on that. Okay? Highs for the day. The average up day in December is much stronger than the down days, percentage-wise. So that's why I'm suggesting more longs than although it works the same way in shorts, but long is really the focus here. 3, 4 days down for this particular next day, same day, whatever the case may be. Same thing, right? Comes back, wants to test those highs. This is the high, this is the test. Now, it took longer than I would have liked. This is the rush to get back up there, and then it flattened out. I don't want you to hold on to something for days on end. I want you to get out, get in and get out, take your profit if possible, and then look for the next opportunity. Now the market made a new high here, right here. It's the same principle. 1, 2, 3, not really indicating a huge type of pullback. I would not consider this. It has to look like this, like this, like this. It has to look more than just what you're seeing on these 3 hours here. So here we are today, big up day. Take a look at tomorrow. I'm just giving you an example. Take a look at tomorrow. Test it. Please don't trade live if you're not comfortable. Just practice it. Go back in history. For the month of December, the more times the market for the day makes a new high, expect 4 or 5 candles, hours, pulling back, and then a retest back up. Now, you don't have to do this 100 times. Do it once or twice for the day and stop. The less you trade, the more accurately you trade, the better. And so the same thing here when I look at the Atlas line. I'm not looking to trade every single setup the Atlas line produces, because as we get into the afternoon or into the later half of the day, the trades, because the market gets slower, I don't think the trades are as good. And it's not just the Atlas line, it's any type of trading that you do. So the market becomes slower and slower and more gappy and wicks with dojis. They don't really help you. 1 point, I would say, is the determining factor whether you should be in or not. When the market's less than a point in a 5-minute chart, it means the last 20 minutes of trading is unable to really push a move higher than 1 point or lower than a point. It's just really slow. And that's where you have a lot of chop. So anything less than a point, my recommendation is stay away. Above a point, consider it more normal or healthy. You want to trade when it's healthy. So here in the morning, there's much more activity, much more action. You have all these long trades here on the Atlas line. The first trade would be this one right here to go long. It resets itself to go long again right here. And let me just make sure I have this right. And I believe this trade here, also another long, but this one was a losing trade. This is a long, this is a long, this is a long. After that, the only other long opportunities besides these bounces, which I don't really count unless they're a green candle, I want to go with the momentum, are going to be here and here, the pullbacks. So the Atlas line gives a lot of signals. It's not the idea to just trade until you drop dead of trading. It's really pick and choose 3, 4 trades and stop for the day. That's my opinion. Questions? Anyone have any questions? Let me know if I'm going too fast. Rick, Sammy, Mike, Harold, just in case you guys have any questions, I don't want to go too fast here. So as we get into the end of the year in December, the last week of the year between Christmas and New Year's, typically this holiday week is slow. But that's okay, because being that we have all of these years of past data, and I want you to please go back in history and verify for yourself, the last week of the year is typically a slow, methodical trend. It'll just trend and trend, typically up, as we get into the New Year's. So as an opportunity, even though the market's slow, it's a great way for you, after opening up all those presents and having Christmas dinner with the family, it's a great opportunity for you on that week of holiday week. Take a look at the market, how it slowly and methodically trends. Now this is a stair-step pattern. The stair-step pattern is something that looks like this. Here, let me go into the future. You think of a staircase and you think of a staircase that